Next up, we've got Alison Murray from Aon, who's going to talk us through some of the stuff from the actuary's point of view. Alison, over to you.
Thank you very much, Chair. I'm hoping I've managed to put my camera on. There we go. Good afternoon, everyone. I'm delighted to have Sam Ogborn with me here today. Sam's another experienced LGPS actuary who works very closely with me on the valuation. And to save you having to listen to me whittering on for the full 40 minutes, we're sharing the presentation and Sam is going to start. So over to you, Sam. Thank you.
Cool. Thank you, Alison. Can you hear me okay? Excellent, thank you. Right, yeah, good afternoon, everyone. As Rodney already mentioned, we're currently partway through the 31st of March 2022 actuarial valuation. And so as you'd expect, most of our actuarial update today is going to be around the 2022 actuarial valuation. So we've got some background on what a valuation is, what we have to do as actuaries. We'll then talk about the funding position for the whole of the pension fund and the resulting employer contribution requirements, before Alison takes you through the outlooks for specific employers, followed by a bit of a summary on the valuation and then a quick update on some regulatory items. So I will start off then by talking about what an actuarial valuation is. So at its core, it is two things. It's an assessment of the financial health of the pension fund, and then it's the setting of the contributions payable by pension fund employers to cover the cost of the promised benefits. So starting with the first part of that, then the financial health assessment. What we're doing is we're comparing the assets held by the pension fund with the past service liabilities. And those liabilities are calculated by us as the fund actuary based on membership data in respect of the fund at the valuation date, and then some assumptions about what we think is going to happen into the future. Where the assets held are higher than the liabilities, there is a surplus in the fund, and where the assets are lower than the liabilities, there is a shortfall or deficit in the fund. We also work out a funding level or funding ratio, which is what Rodney referred to earlier, and that's calculated as the assets divided by the liabilities. And our target situation from an actuarial point of view is to get to a position where the assets held equal the calculated value of the liabilities with no surplus or deficit, and that funding ratio is exactly 100%. So that covers the benefits earned up to the valuation date. But whilst individuals are members of the fund, they're also earning more pension benefits, and those benefits need to be paid for by employers. Those are called future service liabilities, and we can calculate what those are for individuals in the pension fund at the valuation date. We work that figure out as a percentage of pensionable salary, and that's called the primary contribution rate. As I mentioned earlier, we're looking to get to a position where there's no surplus or deficit and the funding ratio is 100%. So we get there by making an adjustment to the primary rate called secondary contributions. Where there's a deficit in the fund, the secondary contributions will be an additional contribution to be paid. And where there's a surplus, the secondary contributions will be a deduction against the primary contribution rate. The LGPS regulations require an actuarial evaluation to be carried out every 3 years. So as I said, we're currently carrying out 31st of March 2022. The last was at 31st of March 2019, and the next will be at 31st of March 2025. We get a year to complete the valuation, and then changes to the employer's contributions come in after that year. So you'll see changes in your employer contributions from 1st of April 2023. So I mentioned briefly that in order to calculate the past service liabilities, we need to take account of the member data, make some assumptions about what's going to happen in the future. The point of this slide then is just to show what a liability calculation looks like. So the bars on the right-hand side in the chart, they represent expected cash flows for all members in the pension fund at the valuation date. This isn't West Yorkshire specific, it's just an example, but it follows the same pattern as we would see for the West Yorkshire Pension Fund. So starting at time zero, we have expected cash flows in respect of current pensioners. They're the benefits that are going to be paid out in the next year. And then over time, we'd expect the amounts of benefit being paid to increase as the membership ages and more people's benefits come into payment. We then reach a peak where the amount of pension that is dying starts to overtake the amount of members that are retiring, and therefore the expected cash flows tail off into the future until the last member of the scheme dies somewhere around 80 years after we started. So that's purely an example to show you how the calculations work. In reality, there's new members coming in all the time, so this bell shape doesn't actually end after 80 years. It sort of continues into the future. But what we're doing here at the valuation is we are carrying out these calculations for every single West Yorkshire Pension Fund member. So that's the 308,000 records that was mentioned earlier, use an assumption specific to the West Yorkshire Pension Fund, and then we discount those expected cash flows back into today's term to determine how much money is needed to be set aside now in order to meet all future West Yorkshire Pension Fund benefit cash flows. That is essentially how we calculate a liability value. So looking into the data then that we use to do those calculations, the chart in the top left shows the number of active members, so those who are currently employed by a West Yorkshire Pension Fund employer and earning benefits at the valuation date. Deferred members, so those that have left active employment or have chosen to no longer contribute to the pension fund, but have not yet retired. And then pensioner members, so those currently in receipt of a pension from the West Yorkshire Pension Fund. I've shown the summaries at the last 3 valuation dates, so 2016, 2019, and then this 2022. As has already been mentioned, there's 308,000 records at the 2022 valuation. That is more than at the previous valuations, so we would expect the liabilities to have increased since the last valuation, given that we've got more people now. Although the assets should have also increased, because where new members are joining, employers should be paying that primary rate of contributions to cover the benefits being earned by those members. The profile of that membership, shown in the bottom left of the slide, that's remained reasonably consistent over the 3 years. The average ages are pretty much the same between the 3 years. There's a very slight increase potentially, but nothing significant. So we wouldn't expect to see any significant changes in our liability calculations as a result of membership profile changes. But there have been some changes in financial experience. So firstly, pension increases. So they're linked to CPI. At the 2019 valuation, our assumption was 2.1% per annum of increases. The actual experience has been a little bit lower than that on average. So the first year, the 2019 increase, the 2020 increase was 1.7%. The 21 increase was 0.5%, and the 2022 increase was 3.1%. So the fact that those on average have been a bit lower than our assumption means that the liabilities have dropped slightly compared to what we would have expected. And then similar story on salary increases, which impact on benefits earned before 1st of April 2014 for active members. Based on our analysis, actual salary increases have been around 3.15% per annum, compared with our assumption at the last valuation of 3.35% per annum. So again, a slight reduction in liabilities allowing for that. And I have quoted the 2022 assumptions on there, but we'll go into those in a bit more detail, so I'm not going to talk about those any further at this moment. The biggest impact, though, as has already been mentioned, is that asset returns have been particularly strong on the West Yorkshire Pension Fund. So since the 2019 valuation, the asset return has been 27%. At the 2019 valuation, we had a discount rate of 4.35% for the majority of the liabilities. So in order for the assets and the liabilities to increase at a similar rate, we would need asset returns of 4.35% per year. Actually, they've returned 8.4% per year. So that means that the assets have outgrown the liabilities over that 3-year period. Looking at the assumptions then in a bit more detail. So I mentioned discount rate briefly there. I've also mentioned CPI inflation and pay growth assumption. Those are all financial assumptions. They're shown in the blue hexagons on the slide, and those determine the amount of the expected cash flows in the future. But we also need to make some assumptions about the likelihood of the cash flows actually being paid, which we call demographic assumptions. And we've split those into 3 categories here with different shades of grey. So the darker shade, so that includes assumptions about mortality rates, both pre and post-retirement, the likelihood of members not making it to their normal retirement age due to either ill health retirement or withdrawal from service, and then also the rate at which members give up pension for cash lump sums on retirement. And for each of those dark grey hexagons, we carry out an analysis of the experience of the West Yorkshire Pension Fund over a number of years, and then we set assumptions specific to the West Yorkshire Pension Fund for the future based on what's happened in the past and use an actuarial judgment. For the slightly lighter grey, so that's the proportion with dependents and the retirement patterns, those we actually base on our portfolio of LGPS funds that we advise. There's not a great deal to be gained from just looking at West Yorkshire Pension Fund specific information there. And then the final demographic assumption on the slide is the take-up of the 50-50 scheme option. And our assumption for that, I mean, there's very few members at the moment who've taken up that option. So our assumption for that is purely to assume that where people are already in the 50-50 section of the scheme, they'll continue in that section of the scheme. The most significant demographic assumption, though, is the post-retirement mortality assumption. The reason being is that has the biggest impact on how long we expect benefits to be paid for. The experience analysis we do for that is actually a bit more detailed than for the other demographic assumptions. So we've just put together this slide to explain a bit more about what we do to determine that post-retirement mortality assumption. So mortality assumptions generally can be split into two parts. You've got the base table, and that is a backwards looking part. So it's looking at what's happened in the past. And then we've got future improvements, which is a forward-looking part. So how do we expect mortality rates in the future to change versus what we saw in the past? So to determine that base table, what we do is we use experience data from the West Yorkshire Pension Fund. We have 10 years of data that we've used in our analysis this time round. We then utilise Aon's longevity model called Demographic Horizons, which has a database of mortality information across the country by postcode. And by combining those two items, we're able to generate an assumption specific to the membership of the West Yorkshire Pension Fund. The future improvement parts then is taking into account information published by the Continuous Mortality Investigation, the CMI. That's a part of the actuarial profession, and what they do is they record information on mortality rates across the whole country, and they publish base tables and future improvement projections, which we can then adjust based on Aon's mortality experts' views and experience of the West Yorkshire Pension Fund. Again, what we're trying to do is get a specific assumption for the West Yorkshire Pension Fund membership. And obviously, over the last 3 years, we've had the COVID-19 pandemic, so we have adjusted our assumptions to take account of the pandemic in both the base table and what we think is going to happen in the future, allowing for Aon's mortality expert views on how we think mortality rates might change going forward. In terms of how that change then, allowing for all that experience impacts on the liabilities, in the bottom left-hand section of the slide, I've shown the life expectancies from age 65 for 4 different categories of member. So males who are currently 45, males who are currently 65, females who are currently 45, and females who are currently 65. And you can see it's not had a massive difference in the life expectancies. And actually, in terms of the impact that leads to on liabilities, we think that's about a 1% reduction in liabilities at the 2022 valuation compared with what it would have been if we'd used the 2019 assumption. Although just note that we're not seeing a full 1% come through on the liabilities because we have changed some of those other demographic assumptions that I mentioned early on. So moving on to financial assumptions, and firstly the discount rate. So we're first looking at the secure long-term bodies, and at Aon we operate a risk-based approach for calculating the discount rate for long-term secure bodies. That's where we allow for prudence in our assumptions, which is something that we're required to do as actuaries. So we start by looking at the assets that the fund's going to invest in over the longer term. So for the West Yorkshire Pension Fund, we were provided with the split on the right-hand side by the administrative authority. And using that information and then information from our investment specialists, we can calculate what we call a best estimate, meaning that it has a 50-50 chance of being borne out in practice, a best estimate expected future return on the fund's assets over a given modelling period, which we've set as 20 years. But as I mentioned, we do need to allow for prudence, and as a fund, you don't want to be in a position where you only have a 50-50 chance of being able to pay all benefits in the future. So what we do is we look at different options called probabilities of funding success, and having considered all the options we presented to them, the fund has opted for a 76% probability of funding success at the 2022 valuation. So that means there's a 76% chance of being able to meet all future benefits. That in turn translates to a discount rate of 4.5%. And then that discount rate will be used in calculations for employers who are long-term secure scheduled bodies. We did adopt the same approach at the 2019 valuation for setting the discount rate. The only difference then really was that the fund adopted the probability of fund success of 75% at that point. So a very slight increase in the probability of fund success now. That has been made, as Rodney mentioned earlier, to reduce the risk in the fund's funding strategy. And all that means really is that the payment of benefits in future then is slightly less dependent on strong asset returns and can be backed more by contributions coming in from employers. But the fund is very mindful that the impact on contributions payable by employers needs to be not too significant, and so they've not opted to increase the probability of fund success any further at this valuation. The fund isn't just made up of long-term secure scheduled bodies though, so we do need to determine how to value the other types of body. So the fund has a policy of requiring higher contributions from bodies that are not long-term secure scheduled bodies. The reason being that those bodies pose a greater risk to the fund of a deficit being left behind for all other employers to pick up if one of those employers was to suddenly leave. There are a few different types of bodies, so I've listed those on the slide. I'm actually going to start in the bottom right. So exited employers, so employers who have already exited the fund without a subsumption commitment from a long-term scheduled body. Therefore, they won't be available to meet any deficit on their liabilities in the future. So what we do here is we calculate a low risk discount rate, and that's designed to reduce the chance of any deficit arising on the liabilities in the future due to asset returns being lower than expected. We've then got ongoing orphan bodies. So those are bodies where we know they're going to become an exited employer in the future. And we want to allow for the fact that the fund is earning asset returns above the low risk rate whilst the employer is still active, but also have an eye on the end position, which is that there will be no specific employer to back the liabilities once that employer exits. And then we also have intermediate employers, and those are generally long-term employers, so not expected to be exiting in the near future, but they're not tax-raising bodies and therefore could leave behind orphan liabilities if they were to exit, and so a higher risk to the fund than the long-term scheduled bodies. The fund actually uses 3 different intermediate funding targets, and employers are classified into one of those 3 targets based on a financial risk analysis, which we carry out for the fund using data provided by those bodies. So at the 2019 valuation, the discount rates for these 3 types of bodies that I've just mentioned were set relative to gilt yields. However, the fund did make a decision earlier this year to move away from that approach and to actually use our risk-based approach that we use for the secure scheduled bodies. So we're using a similar approach now to calculate the discount rate for all types of body in the pension fund. The difference being then that the probability of fund success we use for these bodies is higher than the 76% to allow for the extra risk posed by these bodies. In addition, for the low risk exit basis, we actually use a lower modelling period. We've reduced that to 15 years, and that's to allow for the fact that those bodies are of shorter duration, shorter term, and just because there's no active members there to continue the participation of the employer. So just looking at the chart then on the left-hand side, for the 3 intermediate funding targets, we have probability of fund success of 80% for the lowest risk intermediate employers, and that equates to a discount rate of 4.25. So that's 0.25 lower than for the secure scheduled bodies. For the medium risk intermediate employers, a probability of fund success of 83%, leading to a discount rate of 4.05%. And then for the higher risk intermediate employers, a probability of fund success of 85%, which equates to a discount rate of 3.95%. And then that low risk exit basis that I mentioned, we've used a probability of fund success of 95%, which equates to a discount rate of 1.6%. So the one I haven't mentioned then so far is the ongoing orphan employers, and what we do for them, because we know they're going to exit and be on that low risk basis in the future, but as I said earlier, we want to allow for the fact that whilst they're still participating in the fund's expecting higher returns than the low risk basis, we operate what's called a split discount rate, where the discount rate is set equal to the higher risk intermediate funding target whilst members are still active, and then that switches to that low risk funding target when members become non-active. So that way we're smoothing the transition to exit for those employers. Moving on to the CPI assumption then. Our CPI assumption is a long-term best estimate of what Aon specialists think inflation will be in the future. So that's taken from our capital market assumptions at the valuation date. At the 2022 valuation, that figure is 2.3% per annum, which is a slight increase on the assumption at 2019, which, as I mentioned earlier, was 2.1% per annum. However, as you'll no doubt be aware, and I think has already been mentioned, inflation is running at a very high level currently. The pension increases that apply to LGPS members is set based on inflation from September to September. Inflation from September 2021 to the valuation date was 4.2% for that half a year. And we now know, as Rodney mentioned earlier, that the annual inflation to September 2022, and therefore the pension increase that's going to apply from 2023, is going to be 10.1%. So when setting our capital market assumption back at 31st of March 2022, that was a forward-looking analysis. So it didn't account for the 4.2% in the period September 21. onwards. Up to September 2021 was included in the March 2022 pension increase of 3.1%, but we've not allowed for that bit for the 6 months from September 21 to 31st of March 2022. And then, as I mentioned, we set the assumption a while back now. We didn't know what inflation was going to look like. A lot's changed since we set that assumption. And as a result, if we were to maintain that assumption we set back at 31st of March of 2.3%, what would happen is there would be a huge step in liabilities next April when the pension increase comes through at a much higher level than 2.3%. And we've also got the fact that we don't know what's going to happen in future with inflation. Is that going to continue to 2024? Will the 2024 pension increase also be higher than 2.3%? So, to avoid a situation where the valuation at 2025 is much worse than expected, leading to big increases in employer contributions from 1st of April 2026, what we've done at this valuation in agreement with the fund is to add a 10% load into the liabilities to account for these short-term inflation pressures. We do believe that's reasonable given the unprecedented situation that we're in, but if that does turn out to be too high and inflation next year, for example, isn't quite as high as we think it could be, then employers are still getting the benefit of any additional contributions paid now, and that will then be taken into account when setting contributions at the 2025 valuation. Okay, so this slide then is really just bringing together what I've been talking about over the last 3 slides, showing a comparison of the assumptions at the 2019 valuation and the 2022 valuation. I'm not going to talk any further about that. I believe you'll be getting a copy of the slides. I think they'll be available online for you to look at. But the only other thing I did want to mention on here is the information in brackets on the slide. So, for example, just here where I'm pointing now, all that's there for is to show you how the derivation of the discount rate has changed between the 2019 valuation and the 2022 valuation. Okay, so with all that background information then, appreciate I've gone through quite a lot quite quickly there. We'll now have a look at the 2022 valuation position. Before we do that, just to recap on the 2019 position. So at 2019, the fund had assets of around £14.4 billion. Based on the approach I described earlier, we carried out our calculations of the liabilities and we determined the value of the liabilities to be just under £13.5 billion. The assets were higher than the liabilities, meaning there was a surplus in the fund of around 866 million. And the funding ratio, which remember is the assets divided by the liabilities, was 106.4%. At the 2022 valuation, the draft results show that the liabilities have increased to around 16.6 billion. Assets have also increased to just shy of 18 billion, as was mentioned earlier. So the assets again have increased by more than the liabilities, meaning there's a surplus still, and that surplus has actually grown from 866 million to just over 1.4 billion pounds. And the funding ratio, as Rodney mentioned, has increased by 2.1% from 106.4 to 108.5%. So why has that position changed? Based on the chart on the screen, you can see there's 2 very big bars there in opposing directions. So asset returns, as I mentioned earlier, have been really strong. They've increased by far more than the discount rate. So that's led to an improvement in the funding position of around £2 billion. But that has been partially offset by an increase in liabilities due to CPI, long-term CPI increasing, and then also that 10% load-in that I mentioned that were included in this valuation. There's also a small relative reduction in the discount rate where we've moved from 75% to 76% probability of fund success for the secure scheduled bodies. There's also another sort of 4 small items there on the chart. So interest on existing surplus pay and pension increases, they've all had a positive impact on the position over the valuation period, along with demographic assumptions, as I mentioned earlier, but they have been partially offset by contributions being paid at lower levels than the cost of benefits being earned due to employers recovering some of the surplus that was present at the 2019 valuation. So good news overall, but it is important to note that the fund faces a number of risks and that changes in the market conditions or assumptions could have a significant impact on the results. So this chart is purely designed to show the sensitivity of the results to different changes in those items, and just draw out the main ones there. So if the discount rate or CPI inflation were to change by 1%, that could change the funding level by around 17%. So quite a big change. And more significantly, if equities were to fall by 25% and the fund's heavily invested in equities, then the funding level would actually fall by around 20%, from 108% down to 88%. So I've talked about the assessment of the financial health part. I said the other part of an actuarial valuation is setting of contributions. So we'll now look at that at whole of fund level. Firstly then, and I think Rodney mentioned this briefly earlier, at the 2019 valuation, we included an allowance in contributions for potential liabilities in respect of the McCloud judgment, which was an age discrimination case affecting all public sector schemes. The expected result was that some members would get an improvement in their benefits to reverse out the impact of the age discrimination, and that would therefore lead to additional liabilities. We didn't have a massive amount of information about that at the 2019 valuation, but based on what we did know, we calculated that the improvement in benefits was likely to cost around 0.9% of members' pay per year on average, and therefore we increased all contributions at the last valuation by 0.9% of pay. We now actually have a lot more information on what the exact remedy in order to remove the age discrimination is going to be. So we're now able to carry out more accurate calculations at employer level based on the membership profile of each employer. The liabilities arising from the McCloud judgment are expected to end by the time the new contributions come into force from 1st of April 2023. So what we've done is we've moved the allowance for McCloud liabilities from the contribution rate payable to be included in the past service liabilities at this valuation. So with all else being equal, you'd expect contribution rates to come down slightly because of that. The exact impact is going to differ by employer depending on the employer's membership profile, but at whole of fund level, we've calculated that that's increased liabilities by around 0.6%. So whilst the valuation position looks pretty good, things since the valuation aren't looking quite as good, unfortunately. Assets have not performed as well as assumed. Specifically for the West Yorkshire Pension Fund, assets have been around 8% lower than the discount rate to 30th of September 2022. And remember I said that the funding ratio was 108.5% at the valuation date. That would mean that at 30th of September 22, there's pretty much no surplus left. So the funding level would be more like 100%. That is before any changes to our assumptions are factored in though. We don't have our assumptions available at 30th of September yet. Unfortunately, this meeting's come maybe a day or two early. For our central team to calculate the projected information that we need to work out our assumptions. But we do know that at 30th of June, the CPI assumption had decreased very slightly and the discount rate had increased. So that would lead to a reduction in liabilities, which would go alongside the reduction in assets, although the assets would have reduced by much more. But really, it's very tricky to say at the moment what the position at 30th of September is going to be like, because markets are currently very volatile, so it's not at all clear whether the surplus still exists at 30th of September and whether it will do going forward with an eye on the next valuation. So to combat these post-valuation movements that we've seen, again with an eye on ensuring employers are not significantly under contributing and setting themselves up for a massive increase at 2025, we've agreed with the fund to only permit reductions against the primary rate in respect of surplus over 105%. So remember I mentioned earlier that secondary contributions, where there's a surplus, we reduce the primary rate. We're only going to reduce it for amounts over 105%. So for example, if an employer has a surplus of 104%, we'd be asking them to just pay their primary contribution rate with no reduction, i.e. we're making no allowance for that 4% surplus in their contribution requirements. And if an employer had a surplus of, say, 108%, we would calculate a reduction to the primary rate, but only in respect of 3 of the 8% of surplus. Hopefully that makes sense. So this slide then summarises the results at the whole of fund level. These figures are aggregate rates of all the individual employer rates, and you will get your own result, allowing for your own specific circumstances in due course. But this does give us a general feel of what's happened since the 2019 valuation. So the primary rate, which is that grey bar in the middle, that has changed from 18% at the 2019 valuation down to 17.9% at the 2022 valuation. look down a line and we've got the allowance for McCloud. That was included at 0.9% at the last valuation, as I mentioned earlier, but that's no longer in the contribution rate at 2022, so not applicable at 2022. But there has been a change in the secondary contribution rate because we're not recovering any of that surplus below 105%. So at the 2019 valuation, we had a 6.4% surplus and we were recovering that in full. Whereas now we're only recovering 3.5 of the 8.5% surplus that we've got, which means that the reduction to the primary rate for the secondary contributions is only minus 1.4% now, whereas it was minus 2.3% at the 2019 valuation. Again, that is an aggregate rate, so individual employer results won't necessarily see the same impact on their contributions, but at whole of fund level, we're seeing a very small reduction in contribution requirements from 16.6% to 16.5%. Okay, thank you very much, everyone. I'll pass over to Alison now to talk through the rest of the presentation.
Thank you, Sam. Can move the slides on. So yeah, just wanted to give a little bit more colour in relation to the potential outlook for the different employer groups. As Sam has indicated, we do apply slightly different funding targets depending on employer circumstances. And this first slide then just summarises those different funding targets that we operate. So we have a funding target that applies to the secure scheduled bodies, and also that includes the town and parish councils whose contributions are pooled together rather than set individually. That was introduced at the last valuation, and that's largely to try and help stabilise contributions for those employers because individually they are reasonably small. And in addition, at this valuation, and there was a session last week, we are proposing to calculate the contributions for academies collectively as part of a new academy pool or group. But for the avoidance of doubt, the underlying funding target in terms of the probability of funding success, the 76% that Sam has taken you through, that applies to all the secure scheduled bodies, so the councils, police, fire, and both the town and parish council pool and the academy pool. But it does mean with the introduction of these pools, the movements and contributions may be slightly different for those employers. We've also got, as Sam indicated, employers who are not expected to leave immediately, but are perhaps haven't got the full backing of taxpayers and therefore are deemed to be slightly less long-term potentially or slightly more risky than the council. So we do have a slightly more prudent approach for them. And then at the bottom there, the employers whose participation in the scheme is not a requirement, if you like, of the LGPS regulations. Many of them may well be closed to new members, and therefore we have an eye on what we would do should those employers exit when we set their contributions. So if we take those groups individually on the next slide, we can move on, thank you. So for the secure scheduled bodies, the cost of benefits being accrued in future, the so-called primary rate, there's upward pressure on that due to the increase in inflation expectations. And when I talk about that, I'm talking about the increase in the long-term best estimate inflation assumption. So the 2.1 as it was at the 2019 valuation, that is 2.3 at the 2022 valuation. So that on its own increases the primary rate. The percentage of pay rates generally, that's been offset by the fact, as Sam indicated, we no longer need that 0.9% of pay that we allowed for in 2019, which was due to both the McCloud judgment and also expectations of the 2016 cost management process that we thought, when we did the valuation last time, was going to lead to an increase in employer contributions. Since then, the McCloud judgment has been allowed for in the cost management process such that no changes are needed to members' benefits or contributions on account of the 2016 process. There is a judicial review ongoing, but for this valuation we have been able to remove that 0.9% of pay allowance that was made in 2019. In terms of the funding position, due largely, as Sam has said, to the very positive investment returns achieved by the fund, the funding position generally will be slightly higher at 2022 than it was in 2019. Although that may be partially offset for any employers who had taken advantage of having a surplus at 2019 and using that surplus to partially subsidise the cost of benefits accruing between 2020 and the 2022 valuation date. Because of the uncertainty as regards to the future economic outlook and the fall in the asset value since the valuation date, as Sam has indicated, the proposed strategy is that there will be no allowance for any surplus between 100 and 105% funding level. So you won't be able to use the surplus that may have been there at 2022 to subsidise the primary contribution rates, and that's largely because that surplus may well have disappeared, and it's really not at all obvious what the future outlook is going to be, and we're very, very keen to try and keep employer contributions stable. The fund has a long-term history of doing just that, and the last thing we want is to have a reduction in contributions at this valuation to be followed by an increase at the next valuation if the economic outlook does not improve. These are still sort of quite generic messaging. A lot of the employers are, their position is assessed individually, and therefore the position for you as an employer will depend partly on where you were in 2019. You all had different funding positions, your membership profile, what's happened to that membership. And just to give you an example, if your active membership has aged since 2019, that will generally mean an increase in your primary contribution rate, simply because there is a shorter period over which you can earn investment returns, which leads to a higher percentage of pay rate being required. And as I mentioned, due to the pooling arrangements in place for town and parish councils and academies, the results for those employers may be slightly different. Moving on then to the employers subject to the intermediate funding targets, it is just worth saying that all employers have the same investment strategy. And that was one of the reasons, as Sam mentioned, that the way in which the funding targets, the way in which the liabilities are now calculated for all the employers is all structured in terms of a risk-based approach, looking at the actual investment strategy of the fund. So that has meant that the funding target has shifted slightly for the intermediate employers and the ongoing orphan employers. Broadly speaking, for the employers subject to the intermediate target, on average, we think the primary contribution rates are likely to have reduced, with the higher inflation expectation having been offset, as I mentioned, in relation to the other employers, by the removal of the 0.9% of pay for McCloud and cost management. The funding position also likely to have improved, although we expect that there will be greater variability than for the other long-term secure employers, and that's just simply because this is a slightly more disparate group, having come from different positions when we sort of drill down looking at them individually. So we may find that there are some small contribution increases for some of the employers. That may be partly because some employers may not actually have a surplus at the valuation date and may have had actually a slight deficit at that date. Any that do have a surplus at the valuation date, the same rules will apply in relation to not being permitted to use up to 5% of that surplus to subsidise the primary contribution rates going forward. And then finally, moving on to employers subject to the ongoing orphan funding target. Again, funding levels likely to have increased because those employers also get the benefit of the very positive investment performance that we've seen. And indeed, in some ways, actually, that improves their funding position slightly more because the assumption that's built into the liabilities is lower than for the long-term secure scheduled bodies. And therefore, the difference between the actual achieved return and that assumed is greater. In addition, a number of those employers will have been paying deficit contributions, which will have improved the funding position further. As you'd expect, the whole point of those deficit or the secondary contributions is to try and target a position of 100% funded. So that's the kind of good news element of it. Having said that, we do expect that in terms of the exit position, so we also, as part of the valuation for these employers, calculate an indicative position, assuming that the employer had exited on the valuation date. And as you may have spotted, or depending how eagle-eyed you are, that the way in which we calculate the exit position is to use the lower risk discount rate. So the exit discount rate at 2022 valuation was 1.6%. For the ongoing orphan funding target, where employers are still active, we use a split discount rate. It is 1.6% for the left service liabilities, but it's 3.95 for the period while active members are still in service. And therefore you will find that the exit deficit is bigger typically than the ongoing exit deficit. For these employers then, many will be shorter term, may not remain in the fund for the longer term, and therefore arguably post-valuation date events are more significant for them. We are going to be having a look at what the discount rate would have been on an exit basis at the end of September before deciding exactly where we will pitch the contributions for these employers. So it's a bit of a wait and see at the moment. We want to be fair to employers in this category, but equally we need to ensure that we are still targeting the position on exit. And for these employers, given that we have effectively two discount rates, those that apply while active members are in service and those that apply when active members leave service, and of course to the deferreds and pensioners, the maturity of these employers, by which I mean the average age of the active members and the proportion of liabilities across the different membership categories, will have quite a big bearing on the overall results. So we do expect, as always, there to be a reasonable degree of difference between the results for employers within this funding target. All of which is a very long-winded way of saying, unfortunately, you're going to have to wait and see before we can really confirm the results for the individual employers on this funding target. So just in summary, then, as I mentioned, there will be slightly different outcomes for the different employers depending on the funding target and depending on your own experience. We are using our long-term best estimate CPI assumption for all of these funding targets because that's then consistent with the capital market assumptions that we use to calculate the discount rate. So all the liabilities will have the 10% inflation allowance applied, as Sam has indicated. And in addition, in all cases, we are expecting that you will not be able to use a surplus up to 5% to subsidise the cost of benefits accruing in future. All of which is really intended to try and get the right balance between stability of contributions as well as kind of reducing risk for the fund. And just in terms of kind of next steps, so the funding strategy statement is a key fund document. We, as the actuaries, are required to have regard to that when doing the valuation, and it is of course reviewed at least every 3 years, more frequently as needed. That will then be updated for some of the principles that we've taken you through today. There will then be a consultation with all of you as employers. The intention is, I think, that will run later in the year, and the funding strategy statement will hopefully be approved by the Joint Advisory Group at their meeting at the end of January 2023. It's a regulatory requirement for us to sign off the valuation report by the end of March in the year following the valuation, so 31st of March next year. And that will also include what we call the rates and adjustment certificate, which is effectively the schedule that's appended to the valuation report, which sets out the contributions for each of the 3 years for each employer. And I see there's a very helpful question there about when you might see those results. We will be going through and producing the employer results over the next couple of months and sharing those with the administrative authority, with the fund, for onwards transmission to you as employers. Our aim is to have all of those results out by Christmas. The only time that may not happen would be if there's a particular issue with any employer results, if we discover that actually there's something wrong with the data or there's something else that needs further investigation. But the plan certainly is that we will be producing those this side of Christmas. And I think that is all I was planning on saying on the valuation. I believe there is a question and answer session later, and I'm also conscious that it's now 3:10, which I think was our end time. Sam mentioned at the start there, we were also proposing to have a little regulatory update. There are lots of slides in the slide pack. I wasn't actually planning on going through them at all, but when you get the slides coming around, please do take a look if you're interested. I think that the key point that I wanted to make is that, as ever, nothing stands still in the world of pensions, and the LGPS is no different. And there are a number of initiatives that I thought it might be helpful for you to be aware of. Some of those relate to things like governance, which the administrative authority will largely be taking on board and dealing with. We also expect regulatory changes for various discrimination cases. So if you are interested, please do have a look at those slides when they come round. And otherwise, I believe if you have questions after this session, if you could send them through to the fund. But I see Councillor Thornton has reappeared, and I think that's a cue for me to then say thank you very much. And that's it for me. Thank you.
Thanks, Alison. No, it wasn't a cue to get you to stop, but you did seem to be coming to the end of what you were saying, so I thought I'd better come back in. So thank you for that.